Okay, so we've discussed the difference between investing and speculating. I'd like to move forward and address something that I believe is fundamental to deploying capital, and that is understanding the difference between valuing or valuations and pricing. I'll say that again. There's a difference between valuing an asset, valuing a business, or pricing the business or asset. Let me put into context. Use definitions again. In order for you to value a company, a business, an opportunity, one of the most important things you have to first understand is what the perceived or what the estimated, that's a better word, estimated, because perceived is more of an opinion, not subject to facts and logical reasoning. Calculated, on the other hand, means that you've spent some time doing some analysis. What you have to understand is in order for you to value something, you must be able to estimate what the intrinsic value is. If you can estimate the intrinsic value, then you've done what we call, you've gone through the process of what we call valuation. On the other hand, there is an alternative way to be able to estimate what you believe the asset is worth, and that is a process we call pricing. I'm going to explain both. I use examples so you can see how it works in principle. The intrinsic value of an asset or of a company is simply the present value of its future cash flow, discounted back at a discount rate that is acceptable. What that simply means, to put in very simple words, is if I give you an asset, if that asset generates income every single month or every single year, if I said to you that this asset produces £10 every year, and it will continue to produce £10 in perpetuity, and that simply means producing £10 forever, how much would you be willing to pay me for that asset? Well, in order for you to calculate the value, you would simply say, well, if that asset pays me £10 every single year, in 10 years, that asset would have given me £100. Therefore, if I was going to own this asset for 10 years, then to me, this asset is probably worth £100. If I paid £100 for it, in 10 years, I get £100 back. Now, I'm using a 10-year period, although I said at the start that it could give you that £10 in perpetuity. However, let's limit it to 10 years. The asset pays you £10 every single year. At the end of 10 years, you've collected £100. You've broken even. How much would you pay for that asset? Now, we'll start with some numbers. If you said £100, then I think you're probably a little bit too generous and too charitable with your capital, because that simply means you give someone £100 today and you have to wait for 10 years to get your money back. And this is where the specificity of definitions come in. I define intrinsic value or intrinsic valuation or as the present value of the future cash the asset or the business will generate. Now, what does present value means? Present value means what is its value today? £10 in your pocket today is worth £10. £10 in 12 months is not worth £10 today, because you have to allow for what's called the time value of money. Money is a currency. Currencies depreciate. The depreciation process takes place in many forms. I'll give you the most simple form. it depreciates as a result of inflation. If you print too much money or too much currency, then the value, the purchasing power of that currency will decline. If inflation goes up, it means that you effectively have to pay more for the same product sometime next month or next year. Same product, but it costs you more. So the first thing you have to understand when it comes to investing is that cash in your pocket today is more important than cash in your pocket tomorrow. Therefore, the first question you should ask yourself is, if I have to allow for the time value of money, therefore, there must be a discount rate, there must be an interest rate that I will discount tomorrow's money at. For example, you might say, well, what we call the risk-free rate, or what you might call the risk interest-free rate, is 2%. For example, let's use 2%. Therefore, if I was going to sell you a business and you were told that in that 10-year period, the risk-free rate will remain at 2%, it simply means that every £10 you collect every year, you have to discount it at 2% and bring it back to today to be able to calculate the present value. So what that simply means is, when you've done your calculation, you might come to the conclusion that although the company or the asset will give you £10 every year, at the end of the 10 years, based on its present value today, that asset is only worth £80. So you should be offering less than 100 and not £100. So you might be smart, you might be shrewd and say, although it's 2% interest rate, it could go up, it could come down. Therefore, with the uncertainty, I'm going to make some, what I call, margin for safety, margin of error, because I don't know if that 2% will go up to 4%. And likewise, who knows? This asset, something could happen to it. If it's a company, they might go on strike, something could break down. So that £10 is not guaranteed. Therefore, I will not use 2% as my discount rate. I would like to use 5% so that I cover myself against the potential of risk. When you've done your calculations, you've estimated the £10 every year, you've discounted every year back to today, you might come up with a present value of £61. Therefore, you should be offering £61 for the company or for the asset. That process of estimating the present value of the future cash the asset will generate or the company will generate, we call that valuation. Let's look at a different approach. Let's talk about pricing. Now, but before I move to pricing, let me just say 3 very fundamental points. If you look at the definition, what you recognize is that valuations are based on fundamentals. You're looking at the fundamentals of the asset or the business. You're looking at 3 key fundamental parts of the equation. Number 1, cash. In other words, cash flow. How much cash will it generate? Is the cash increasing or is the cash decreasing, or will it stay flat? You always want assets that produce cash or cash flow that increases or grows. And you want, as much as you can, to refrain from buying assets where the cash flow decreases over time. The second part of that process is you need a discount rate. A discount rate. The discount rate is simply the interest rate. The interest rate is simply based on what the market has agreed as a consensus as what they believe money should be discounted back at. In other words, it's the risk you attach to investing. And number 3, growth. Growth. Is this business or asset growing? Is it dying? Or is it staying flat? Those three parts of the equation make the process of valuing a company or a business or valuing an asset. Intrinsic valuation is not the only way of calculating the value of a company or an asset, but it's one of the most used. And a process we call discounted cash flow, meaning you discount the cash flow of the asset or the company to estimate the value, is one approach that we use. Let's talk about pricing. The best way to explain pricing is to use something that I believe you will understand. If you've ever bought a house, or if you've ever looked at the price of a house, you might want to buy a house and you go to an agent. In the UK, we call them estate agents. In parts of North America, you might call them brokers, or sales brokers, or home brokers, or whatever they might be called. You see a description of a building, or a flat, or a house, or a home, or even a business or a company, and it says £200,000. The question I ask is, you're buying a home, or you're buying a house, and it's been priced at £200,000. Did the agent carry out an intrinsic valuation for the house? The answer is no. What they do is they use what we call comparables. In other words, you use properties that are similar to the one you're trying to buy. So you might look at a street and they might say, well, this £200,000 property is a one-bedroom flat. We've sold one-bedroom flats on this street. We sold one 2 months ago. The one we sold is quite similar in its features, in its size, is similar in its location, is similar in its square footage, is similar in its characteristics, both functional characteristics and aesthetic characteristics and usability characteristics. And therefore, because we sold the property for £200,000, we believe that this property that we're trying to sell today should be priced at £200,000. So they give it a market price, or what is called a market value, of £200,000. Now what they've done is they've used comparables. In addition to that, they've also looked at what is the demand and the supply available in the local area. If there is oversupply, in order to sell the property, they have to reduce the asking price. On the other hand, if it's in a location where there are barriers to entry, where you cannot just build 1,000 one-bedroom flats, then it means that the value of that property will be very attractive, and therefore it can be priced at £200,000. And what that means is that when you price an asset, you always start with a process. Number one, you identify what the asset is. You identify comparable assets or companies similar to the one that you're looking at. Then you identify the differences. You make adjustments for the differences. So for example, you might say this flat has a much higher floor to ceiling height. It has a garage or parking spot. It's south facing. It has access to a garden. That's adjusting for differences. So you identify comparable companies, comparable properties, comparable assets. You identify the differences. You adjust for those differences. And when you've done that process, then you've compared one to another. We call that pricing. So properties usually in the market are priced by those who are trying to sell the properties. However, when you meet an investor who is shrewd and astute or knowledgeable, what they might do is then apply the definition of investing and valuation to that property. So they might say, well, how much cash can this property generate every single year? And they'll apply the process of estimating the cash flow, discounting it back at what they believe to be the required discount rate, and based on that calculation and analysis and the qualitative process of analysis, they might decide this is what I believe it's worth. So in many cases, what you tend to find is in certain markets, you might find a property worth £200,000. Someone who is a first-time buyer might be willing to pay £200,000. An experienced investor might decide it's only worth £125,000 or £130,000. The reason is simply because maybe the first-time buyer is buying a property that he or she will live in. It's a lifestyle choice. Whereas the investor is investing in a property that he intends to use as an asset to generate cash flow. So he's applying a very, very structured process to his investment operation. So he would say, number one, is this investment going to guarantee safety of my principal? Number one. Number two, have I done a detailed analysis of the location, the property, the area? Do I understand demand and supply? And number three, will it give me a good enough return? And is the return adequate? Is it satisfactory? Then he does his calculation, intrinsic valuation. He discounts the future cash flow back to the present. And that tells him what the value is. I'll conclude by saying this. When you value an asset, or when you value a property, or when you value a company, you use fundamentals. You look at the cash flow, you look at its growth, and you look at the risk associated with the asset. And the risk is identified in the discount rate. When you price an asset, you look at comparables, you look at what other assets are going for. But most importantly, you're looking at mood and momentum. You're looking at demand and supply. So in other words, you're looking at macro factors, whereas when you look at valuation, you look at micro factors. Micro factors means you look from the inside outwards. Macro factors means you look from the outside inwards. That's the difference. Neither is right or wrong. It's all a matter of choice. As a good investor, one of the things you must be able to do is recognize both and be willing to apply both to your analysis. In other words, do your valuations and then also look at the price. I'll give you a good example. There are times when if you're buying a property or if you're renting a property, you might find, I'll give you a classic example. A friend of mine lately has been trying to buy a property. And I've used the opportunity as a learning process to teach them what to look out for. And in this particular occasion, they started off, and they would, send me a message and say, I found this property and I think it's a good deal. And I would say, okay, send me your analysis. Tell me what you've seen. And at the start, they would just give me the description. Remember, they would see the property, they would get the brochure, it looks good. And one of the first things I said to them was, I'll give you an example of how I do my analysis. I said, I never look at the photographs. As a matter of fact, I never even visit the property. That's not the first thing I do. The first thing I always do is I look at the floor plan. Why? I'm looking out for, number one, functionally, is it a good floor plan? Number two, aesthetically, is it a good floor plan? Number three, is the floor area large enough? And I'll come back to that. Number four, can I remodel the floor plan? Can I extend? Can I convert? Can I adapt? Can I improve the floor plan in such a way that I can generate more cash flow from the same floor area, or by increasing the floor area? So I'm looking at, can I keep it as it is and maximize the return? Can I improve how it is and maximize the return? Can I extend, remodel, redesign, and improve, extend, my cash flow. That's what I look at first. If it does not pass that first test of floor plan, I'm not interested in looking at the property. Why? Because I'm looking at it from the perspective of cash flow, and I'm looking at it from the perspective of maximizing my return. The second question I asked them is, I said, if you divide the price that it's being sold for by the floor area, you get a matrix, which is the key thing when you're pricing assets. You might get what we call price per square meter or price per square feet. With companies, you hear things such as PE ratio, price to earnings ratio. You might hear things such as the EV to sales ratio, meaning the enterprise value to revenue or enterprise value to sales. You might hear EV to EBIT or EV to EBITDA, which simply means enterprise value to operating income or enterprise value to operating income before depreciation and amortization. But these are matrices, comparable matrices that you use to compare one asset with another. I want to buy Amazon. I say, okay, what's the PE ratio? Okay, then I look at another company. I look at, Flipkart. What is the PE ratio? I might even go as far as looking at Costco. What is the PE ratio? I'm looking at companies that are not the same because no two assets are completely the same. No two companies are completely the same. I'm just looking at comparables. You want to buy a property? What is the price per square meter, per square foot? And as I started to invest time in my friend and explain a few things to them, I noticed something that was quite remarkable. They would send me a property and they would say, we found this and it's selling at £10,000 per square meter. That's too expensive. Because yesterday I saw another one that was selling at £7,000 per square meter on the same street. And here's the point. When you go by aesthetics and visual, that deceives and that robs you of the ability to be patient and do your analysis. If you start with the basics, if you're pricing, always have a matrix. Identify the property, identify comparables, identify the differences, adjust for the differences, and then you come up with a price. But I noticed as time went on that they started to find properties that were a little bit more attractive. They would say, listen, I found this one, it's £6,500 per square meter. So amongst the comparables, it's the cheapest per square meter. Once we've gone past that process, we move to the next process, which is, okay, let's look at the value we can generate from the company or from the business or from the asset or from the property. So I guess in conclusion, I would say this. Valuation is my game. I believe in fundamentals. I believe in microanalysis. There's nothing wrong with pricing, but recognize that pricing is based on mood and momentum. And secondly, pricing is based on, in many ways, demand and supply. And the price of something, if you use pricing, you're relying on someone else's valuation on something you're about to allocate your capital to. So the fact that everyone is paying a PE ratio of 20 for a company doesn't mean you should pay 20, because 20 could be overvalued. You should define what you believe value is. Likewise, if you find a street, the fact that everyone is paying £10,000 per square meters doesn't mean you should pay the same. Let me use a classic example. We seem to be going through a very turbulent financial economic crisis now. For the past 3 years, I've been of the view that 95% of the companies, publicly listed companies and private companies, are priced to perfection, and most are overpriced. The average PE ratio across the US and the UK, you may have come up with a PE ratio of about 17, roughly 17 and a half, median. You may have decided that that is cheap. As of today, that number has dropped, and the average median P ratio, now today's only 3 months from January, today the average P ratio is somewhere in the region of about 11.9. What changed? Is it possible that the value of companies could have declined in 3 months substantially? The answer is no. Businesses, assets, don't change value that quickly. However, the mood, the psychology, the market momentum has changed. The market has become more risk averse. The demand for more companies, to buy more companies or to buy more assets, has reduced. So the key thing to remember is this. If you use pricing, you're dealing with macro factors. You have to be very careful because macro factors change very quickly. It changes as a result of geopolitics. It can change as a result of public health issues. It can change as a result of governmental changes. It can change as a result of economic uncertainty or unforeseen circumstances. These are all factors that you have no control over. However, if you follow valuation, you have a little bit more control because you're looking from the inside out. You're starting with fundamentals. So you simply say, okay, what is the cash flow? What has it generated in the past? What is it likely to generate today? And you can apply a conservative estimate. You don't have to apply a generous estimate. Number two, you can say, what is the potential risk with the asset? What discount rate should I use? What discount rate has been used in the past? What discount rate should I use today? Number three, you can ask yourself the question, is it likely that there will be growth? What is the estimated growth? You can use the past growth, or you can decide to be conservative. I will apply no growth, just to be conservative. My view and my opinion, and I believe this to be somewhat subjective, is that if you value assets, in most cases, you will be right. Now, that doesn't mean the market would agree with you. So for many years, for the last 3 years, if you were valuing companies using fundamentals, you would have found that there were very few opportunities for you to invest in. So you'll be out of the market most of the time. On the other hand, when the opportunities come by, you have much more than you anticipated. If you price, on the other hand, and you follow mood and momentum and the swings of the market and people's opinions and demand and supply, you would overpay most of the time for what you buy. Unfortunately, when the tides turn around, which can turn very, very quickly, one of the things you might recognize, one of the things you might realize is, just as you were able to dance when the music was very loud, the music could be stopped before you know that it's midnight.